Hello everyone, today is the 15th of April 2025 and this is the Just Dario Daily. The topic of today daily is Bank of America's Q1-25 earnings. More smoke and mirrors to hide its insolvency. Bank of America just released its Q1 2025 earnings, and if you thought past balance sheet shenanigans were wild, you are in for another ride. Back in November 2024, in the article How Bank of America is Hiding Its Mounting Problems Behind a Mountain of Repurchase Agreements, we discussed how Bank of America heavily relies on repurchase agreements to maintain liquidity, while its securities portfolio's unrealized losses keep ballooning. Today, we are diving into the latest numbers to determine whether BAC is still playing hide and seek with its problems, or if the cracks are finally too big to conceal. Previously, I revealed how Bank of America was accumulating repurchase agreements, short-term borrowings where securities get swapped for cash with a promise to buy them back later to boost liquidity. It's like using a payday loan to cover your mortgage. It works until it doesn't. In Q4 2024, BAC Repo net balances, assets minus liabilities, were negative by roughly $41 billion, and these balances went further negative in the quarter to negative $48 billion. Here is where things become odd. While the bank reports a roughly $24 billion increase in deposits from the previous quarter to almost $2 trillion, which would suggest an increase in cash balances, in reality, Bank of America's cash and equivalents continued dropping to $273 billion in the current quarter, a drop of roughly $16 billion compared to the previous quarter. Where did all the incremental $54 billion of cash go? Bank of America, which clearly didn't learn much from its mistake in 2020, bet hard on the market by increasing the net balance of its trading assets by roughly $53 billion. Pretty bad timing, right? In fact, rather than strengthening its balance sheet and closing some of the deep holes around it, the bank, like amateur traders do, bet on a comeback of the bull market and on yields going lower, while the exact opposite happened. How many of these quote-unquote trading assets are going to become quote-unquote hold to maturity so the bank can hide these losses in the next quarter too? Now, for the sobering reality. Bank of America's security portfolio, particularly the held-to-maturity book, where losses lurk like skeletons in a closet. In Q3 2024, unrealized losses reached roughly $131.6 billion, decreasing to roughly $112 billion by Q4 as bond markets rallied. Q1 2025, the latest filings show losses in the securities book at roughly $100 billion. Apparently, this trend looks okay, but yet another sign that Bank of America is increasing the risk in its balance sheet rather than doing the opposite. Compared to December 31st, 2024, the total amount of debt securities held by the bank increased from roughly $921 billion to roughly $942 billion. While reducing the hold-to-maturity books by only $8 billion. Likely all maturing mortgage-backed securities, since the balance of U.S. Treasuries remained unchanged. Why do I have a feeling that with rates now on their way back up, aligned with what I said in the previous paragraph, Bank of America will shift assets back into the hold-to-maturity books to hide the losses that are now increasing again? As if this figure wasn't enough, as we discussed before in previous articles, particularly in Is Warren Buffett starting to be worried about Bank of America's solvency? The fact that in the current environment the bank isn't making meaningful provisions for expected credit losses, with another mere $1.5 billion for the quarter, a figure that has remained roughly the same since Q1 2024, is a sign that the bank is significantly underreporting the credit risk in its books that almost exclusively consider interest rates movement in the calculation of quote-unquote unrealized losses. What would be the real extent of the losses if a proper mark-to-market assessment were done on the bank? Besides $550 billion of mortgage-backed securities, let's not forget, mortgage rates are currently at 7.5%, while the bank bought the vast majority of these assets when they were at roughly 3%. Hence, the $80 billion of unrealized losses they report here is an insult to the basics of fixed income assets pricing. The bank also has $1.1 trillion loan book that keeps expanding quarter after quarter, indicating the bank is adding risk to its balance sheet rather than preparing for an eventual economic downturn. Considering that the bank has roughly $250 billion of reported regulatory capital and roughly $100 billion are already the unrealized losses it reports, and the bank has only set aside roughly $14 billion allowance for credit losses against $3.3 trillion of balance sheet, yes, just 0.42%, what are the chances Bank of America is already insolvent if its books are marked to market properly? Perhaps Warren Buffett did the math, which is why he has been dumping his Bank of America shares as fast as possible, trying not to crash the price and not to alarm the large number of investors out there who are still deep asleep. Bank of America's Q1 2025 earnings are, as usual, trying to impress the media with headline profits and trading revenues beating lowball Wall Street expectations. However, once again, the reality is quite different beyond the smoke and mirrors set up by the bank. The Repo strategy indicates short-term desperation, and those hold-to-maturity losses won't disappear without either a miracle or a measured balance sheet overall. Both alternatives are less and less probable. What does have a higher chance of happening is what I discussed in my latest podcast, How the Fed Fell into a Checkmate Trap, with Bank of America being one of those banks most in need of a BTFP 2.0 from the Fed to relieve them from mounting liquidity pressures and the risk of being forced to liquidate assets in the market at a steep loss that can bring them straight to bankruptcy.